Look at Microsoft right now. I mean, is this tech giant, stuck in a falling trend that's just flashing massive sell signals?
Right.
Or is it actually a strong buy that the market is severely undervaluing? Today is April 20th, 2026, and we are pulling back the curtain on this multi-billion-dollar tug of war happening behind the scenes.
And it is a massive tug of war.
It really is. Microsoft is currently navigating a period of incredibly high volatility as we just barrel toward a massive earnings report on April 29th. So our mission for this deep dive is to equip you with the full, unfiltered picture.
Exactly. Getting past the
All
noise.
right, we're digging into the raw financial data, the technical charts, the dark pool prints, and the latest analyst notes so you can see the actual mechanics of what is driving the stock.
There's a lot going on under the hood.
Absolutely. And just to be completely clear right at the top, this deep dive is an educational exploration of market data. We're analyzing the sources to understand how the market functions. But, this is not financial advice.
No, definitely not. We're here to look at the anatomy of a trade,
Yeah.
right? And to understand the conflicting signals.
Yeah.
Because when you have a company the size of Microsoft experiencing these kinds of, well, polarizing indicators right before a major earnings call,
It's intense.
it creates this fascinating high-stakes case study in market psychology, algorithmic trading, and institutional strategy.
Yeah, let's start with the foundation, because to understand why the stock price is swinging so violently right now, we have to grasp the sheer scale of Microsoft's money engine.
The financials are just staggering.
Honestly, looking at these numbers from their trailing 12 months income statement, the scale is almost difficult to wrap your head around.
It really is.
Like, total revenue is sitting at a massive $305.45 billion. Net income is at $119.26 billion. We're looking at diluted earnings per share at $15.98. But the number that I can't stop staring at is their net profit margin.
Ah, yeah, the 39.04%.
Yeah. Yes. Keeping nearly 40 cents of pure profit for every single dollar that comes through the door at a $300 billion scale. I mean, that's practically unheard of.
It's wild.
If Microsoft were a country, just its pure profit would be larger than the GDP of a lot of nations.
Right, a masterclass in corporate efficiency.
Mm-hmm.
And what you have to look at is how that income statement translates into structural stability on their balance sheet.
Okay, walk me through that.
So you're looking at total assets estimated right now at $512 billion.
Mm-hmm.
But, having assets is one thing. How you finance those assets is what determines your true resilience.
Right, because if it's all debt, it doesn't matter.
Exactly. But their debt-to-equity ratio is sitting at a remarkably low 0.32.
Okay, so to put that in everyday terms, that's like someone making $300,000 a year, but their mortgage and total debts only amount to about a third of their total net worth.
That's a perfect way to visualize it.
It's incredibly conservative.
It really indicates a fiercely robust liquidity position. I
Mm.
mean, they are not over-leveraged in the slightest.
Right.
And when you add in the $5.88 billion in recent quarterly free cash flow, you start to see the mechanics of a company that is essentially built to print money.
Yeah, and weather almost any economic storm.
Exactly. They have the cash on hand to pivot, to acquire, or to simply, outlast their competitors.
It sounds like an impregnable financial fortress. And this is exactly where I'm getting hung up. I want to push back on the idea that this 39% profit margin is just going to sail smoothly into the future.
Oh, the costs are definitely rising.
Because from the sources we're analyzing, the costs to keep this fortress secure are suddenly skyrocketing. Can you explain the growing pressure on that margin? Because keeping this machine running is getting unbelievably expensive.
You've isolated the exact tension driving the current panic, really, and the opportunity. The first major crack in the armor of that 39% margin is their capital expenditures.
CapEx.
Right, CapEx. We're witnessing an incredibly aggressive build-out of AI data centers. Now, an AI data center is not just a warehouse with some server racks.
No, it's a whole different beast.
Totally. We're talking about acquiring massive tracts of land, securing dedicated gigawatt power substations, installing highly specialized liquid cooling systems.
Because the chips get so hot.
Exactly. And filling them with millions of high-end graphical processing units. Because of this, their CapEx is ballooning. Projections from our sources indicate CapEx could consume a massive 33% of their total revenue by late 2026.
Wait, hold on. 33% of revenue.
Yes.
If they're pulling in roughly $300 billion, we are talking about $100 billion a year just being poured directly into infrastructure.
Precisely. $100 billion.
That is insane.
They are spending on physical infrastructure at a rate that is historically unprecedented, even for the most ambitious tech giants.
Right.
They're essentially laying the railroad tracks for a completely new industrial revolution based around enterprise artificial intelligence.
And the market, like, conceptually loves the idea of AI.
They love the idea, yes,
Mm-hmm.
but mechanically, the market absolutely hates the reality of how much cash it burns to build it.
Right, the actual bill.
That $100 billion price tag is exactly what threatens to compress those beautiful profit margins.
Okay, so if 33% of their revenue is evaporating into cooling systems and GPUs, you'd expect the stock to be in a total free fall, right?
You would think so.
But when we look at the actual price charts, the story is incredibly mixed. Like, as of today's close, the stock is sitting at $418.07, which is down 1.12% for the day.
Yeah.
And the 52-week range is unusually wide. It stretches from a low of $355.67 all the way up to $555.45.
The trend direction right now is a total paradox.
How so?
Well, on one hand, you have recent momentum from the bulls. The stock successfully rebounded roughly 13% from its March lows.
Okay.
But on the other hand, it is still down about 22% from its all-time high. Mechanically, it's trapped.
Trapped between what?
It's sitting below its 200-day moving average, which, depending on the specific data provider, sits somewhere between $386.09 and $453.
And just so we're totally clear on the mechanics of that, algorithms and institutional traders use the 200-day moving average as this massive psychological line in the sand, right?
Yeah, absolutely.
If the price is below it, the long-term trend is considered broken or bearish.
Exactly. It acts as a tripwire for automated selling.
Wow, okay.
But complicating that is the fact that Microsoft recently managed to retake its 50-day moving average, which is sitting at $401.54.
Huh.
So the short-term trend is turning positive, while the long-term trend looks damaged.
So it's completely caught in the middle, which brings up the biggest question, I think. Who is actually buying and selling in this chop?
Right.
When we look under the surface at the options flow and the dark pools, what is the actual big money doing?
So the order flow gives us a kind of topographical map of where institutions are drawing their battle lines. Right now, high options volume and prediction markets are showing very clear, heavy overhead resistance at the $435 to $450 zone.
Meaning that whenever the price creeps up toward $435, a massive wall of sellers automatically steps in to cap the rally and push it back down.
Yes, exactly. Our sources show heavy whale buy activity.
And those are the massive multi-million-dollar institutional block trades, right?
Correct. Those are happening right at the $450 strike price.
Yeah.
But immediately above that, there is incredibly concentrated selling pressure acting like a concrete ceiling at the $480 strike.
Oh, wow.
Market makers who sell those options have to hedge their positions, which naturally creates a lid on the stock price.
And what about the floor? Because I'm looking at these dark pool prints, and just to make sure I'm visualizing this correctly, dark pools are the private off-exchange networks where massive institutions park billions of dollars in trades quietly, right?
Yeah, that's exactly what they are.
They do it off the public order book, so they don't immediately trigger a panic or a massive spike on the retail exchanges.
That's exactly right.
Yeah.
They trade in the dark to avoid moving the market against themselves while they build a position.
That makes sense.
And the fact that we're seeing incredibly strong dark pool and equity print support sitting in the $403 to $410 range means big money inherently sees value there.
So they're quietly accumulating shares whenever it dips into that zone.
Exactly. And if that zone fails, there is a critical structural floor at the $370 level.
But even with that dark pool support, I'm looking at a very specific, glaring, short-term weakness flashing right now.
The blue trend line.
Yeah, some technical traders are pointing out a recent break of this parabolic blue trend line that occurred just a few days ago in mid-April.
Right.
And they are explicitly flagging this as a bearish short signal. But the bizarre part is it's happening while other core indicators are actually looking perfectly healthy. Like the relative strength index, the RSI, is at 57.02, which is neutral to bullish.
Yeah.
And the MACD is at 4.7.
And that MACD reading is vital.
Right, but break down the mechanism of the MACD for me real quick, because it sounds like alphabet soup. I know it stands for moving average convergence, divergence, but what is it actually measuring here?
Sure. Think of the MACD as a momentum speedometer.
Okay.
It literally takes a short-term pricing trend and compares it to a long-term pricing trend. When the short-term trend crosses over and moves higher than the long-term trend, the MACD flashes a positive number like the 4.70 we are seeing now.
Got it.
Algorithms read that crossover as a green light, signaling that the stock is catching a new tailwind.
So we have a broken parabolic trend line telling the momentum traders that the aggressive upward trajectory of the last year is officially dead.
The end is full.
Right, the engine stall. But the RSI and the MACD speedometer are saying the stock isn't broken at all. It's just catching its breath for the next leg up.
It is a textbook technical contradiction.
Yeah.
When you have algorithmic indicators fighting each other like this, right before a massive fundamental earnings catalyst, it creates a highly toxic environment for traders who rely solely on reading charts.
Because the charts don't know what to do.
Exactly. The charts are confused.
I'm looking at this 30% downside risk from these broken trend lines, and frankly, it makes Wall Street's consensus look completely delusional.
It does seem disconnected.
How do we reconcile these bearish technical signals with the fact that 22 out of 24 major analysts still maintain buy equivalent rating?
It's a massive disconnect.
Yeah.
Those 22 analysts have an average price target of $570.17.
Wow.
They are looking past the short-term algorithmic chop and focusing entirely on the long-term fundamentals.
But even within that optimism, reality seems to be setting in for a few of them, right?
Yeah, they're holdouts.
Firms like TD Cowen and Baird recently lowered their price targets. They dropped them from around $610 down to $540.
Yes.
Now, they cited near-term macro headwinds, things like sticky inflation, interest rates staying higher for longer, which makes borrowing more expensive, and yet they still kept an outperform rating on the stock.
Yeah, they did.
They're essentially saying the macroeconomic weather is getting ugly, but we still think this ship is the best one to be on.
Which brings us to the core philosophical debate occurring in institutional finance right now. Is Microsoft currently severely undervalued? Or is it a classic value trap?
Okay, let's get into that.
The bull view looks at the valuation and says the stock is trading at roughly 22 to 26 times its forward 2026 earnings. When you compare that to its 5-year average of trading at 30 times earnings, it mathematically looks like a discount.
But the bear view is where the value trap argument gets really scary.
Oh, absolutely.
A value trap is when a stock looks cheap on paper, but it's cheap for a very good reason. The underlying business is deteriorating and the price is actually going to keep falling.
Right.
The analogy I keep coming back to is this. Are they building a massive AI casino?
I love that analogy.
Like they are pouring $100 billion into the marble floors, the chandeliers, the high-end roulette tables, hoping the entire world comes to play. But if enterprise customers, the high rollers, decide to stay home because the economy is tight, the house is just stuck paying the massive electric bill.
That is the exact mechanism of what the bears call the CapEx trap.
The CapEx trap.
Yeah. They're explicitly warning that if Microsoft spends 33% of its revenue building this casino infrastructure, and the widespread adoption of enterprise AI software doesn't immediately match that blistering pace of spending,
Then what?
the profit margins will compress severely. Critics in the sources we reviewed are modeling a potential 30% downside risk to the stock price if this AI overspend cycle doesn't yield immediate and tangible returns.
A 30% drop from these levels would be absolutely brutal. It would drag the stock way below that $370 floor.
It would be a bloodbath.
And adding serious fuel to that bear case is the insider activity. We dug into the SEC filings, and over the last 90 days, there has been absolutely no significant insider buying reported. Zero.
None.
It's mostly just been routine executive divestment, C-suite members cashing out their stock options. I mean, if the stock is such a screaming deal at 22 times forward earnings, why aren't the executives backing up the truck to buy more?
That's the billion-dollar question. When insiders aren't buying a dip of this magnitude, it sends a very chilling signal to the broader market.
Yeah.
It suggests that the executives themselves are preparing for a longer, potentially much bumpier road to AI profitability than the sunny PR releases might lead you to believe. They know the CapEx bill is coming due.
So if the bears are legitimately terrified of a 30% drop and the insiders aren't buying their own dip, what on earth is keeping 22 out of 24 analysts so fiercely, stubbornly loyal to this stock?
The trump card.
Okay.
And that trump card is their cloud computing engine, Azure AI.
Right, Azure.
Let's look at the actual performance of that division. It recently surpassed $75 billion in annual revenue. And more importantly, it is growing at an astonishing 34% year over year.
Let's just pause on that. 34% growth.
It's unbelievable.
Finding 34% growth on a base of $75 billion means they are essentially creating tens of billions of dollars in brand new revenue out of thin air every 12 months.
Every single year.
Maintaining that percentage of growth at that colossal scale defies the laws of financial gravity.
It is incredibly difficult to achieve. It proves that the demand for the AI casino is, in fact, real. The high rollers are showing up.
Wow.
This is why we have two completely diverging paths ahead, especially with the April 29th earnings looming.
Okay, let's map those out. Based on all this data, what does the best case recovery scenario look like?
The best case scenario centers entirely around the Azure narrative overriding the CapEx fears.
Okay.
If they report massive backlog growth on April 29th, meaning major enterprise clients are officially signing long-term, multi-billion-dollar contracts to use Microsoft's AI tools for the next 5 years, it proves they have a dominant, unbreakable position.
So the infrastructure bet pays off.
Exactly.
Yeah.
In that scenario, the sheer volume of guaranteed future revenue justifies the $100 billion infrastructure spend, the market breathes a huge sigh of relief, and the stock sees a major breakout past that heavy $450 resistance level.
And the worst case continuation lower, the nightmare scenario for the bulls.
The worst case scenario is that the margin compression hits much harder and faster than expected.
Oh.
If they announce on the earnings call that CapEx is going to be even higher than 33%, while simultaneously warning that macroeconomic headwinds are slowing down their cloud growth,
Then the floor falls out.
that is when the bears seize total control. The stock would likely slice right through that $403 dark pool support, plunging toward the $370 structural floor.
Wow.
And if macro conditions like inflation are truly poor, panic could test levels even lower.
This setup sounds like an absolute minefield for regular investors. You have moving averages crossing over, dark pools acting as hidden safety nets, and a massive earnings catalyst just days away. Why is it that in these exact moments, retail traders so often find themselves getting crushed?
Because retail traders typically misunderstand the mechanics of volatility.
How so?
This setup right now is the ultimate retail trap. An individual investor sees the stock is down 22% from its all-time high and thinks, it's Microsoft, it's cheap, it always goes back up. I'll just buy some short-term call options before earnings.
Right, they try to time the bounce.
Or conversely, they see the broken trend line and try to short it.
But they're buying into a period where the market makers are essentially playing ping pong with the stock.
Exactly. The algorithms swing the price violently between $405 and $430 over the span of a few days.
And the options just bleed out.
Yes. The options decay and lose their value, the market makers collect the premium, and retail traders are completely wiped out just days before the actual earnings report even gives the market a real direction.
And they get chopped up in the waiting room.
That's exactly it, chopped up in the waiting room.
So the consensus outlook from our sources is really split cleanly by the calendar. In the short term, meaning the next few weeks, we are looking at heavy, unpredictable volatility.
Oh, definitely.
The sentiment is what analysts politely call constructive but cautious. But when you zoom out to the long term, the macro view remains highly bullish, driven almost entirely by the belief that Azure is going to be the foundational operating system for the entire AI era.
Precisely. The short term is a tactical battlefield governed by moving averages, margin fears, and earnings anxiety.
Right.
The long term is a strategic investment in the fundamental belief that AI infrastructure is the most valuable real estate of the 21st century. And, well, Microsoft currently owns the biggest plots of land.
Okay, let's bring this all together. We started by asking if Microsoft was in a falling trend or if it was a severely undervalued strong buy.
And the answer is both, depending on your time frame.
Exactly. What we've uncovered is an incredible duality. On one side, you have arguably the greatest fundamental strength of any company on Earth, with an Azure growth engine churning out 34% year-over-year growth on a $75 billion base.
It's an unstoppable force.
But warring against that is an immovable object, a terrifying 33% CapEx projection that threatens to eat their world-class margins alive, broken technical trend lines, and a massive wall of looming volatility.
It truly is the ultimate test of market conviction. I mean, are you buying the current reality of the balance sheet, or are you buying the incredibly expensive future they're trying to build?
And again, as a final reminder, this deep dive is purely an analysis of the market data, dark pool mechanics, analyst notes, and financial reports we've gathered.
Yep.
This is not financial advice, But it is a fascinating window into how the biggest institutions in the world navigate extreme uncertainty.
It absolutely is. And as you watch this earnings report play out on April 29th, I want you to consider the broader implications.
What should people be looking for?
Well, if a juggernaut like Microsoft, a company with over $500 billion in assets and an almost flawless balance sheet, is risking severe margin compression just to afford the infrastructure of tomorrow,
Right.
what happens to the rest of the tech sector if this AI gamble takes years longer to pay off than the market currently
Think
expects?
about that the next time you look at a jagged line on a stock chart. The X-ray is definitely murky right now.
Yeah.
Keep your eyes on April 29th. Thanks for joining us on this deep dive.